Welcome to TheoTrade. This is Don Kaufman. It's January 22nd, 2019, and you are watching the TheoTrade evening video. Just about 10 minutes left inside of today's trading session. And people, volatility is kind of fighting its way back into the hearts and minds of many traders. The S&Ps here are off by about 1.8%, Nasdaq off by about 2.3%. As I said, still about 10 minutes left to play in the period. Now, I want for a moment to back away from individual stocks. Let's back away from earnings announcements. Let's back away from whatever you might think about this marketplace, because the bottom line right here, right now is, okay, what matters, what levels, what's volatility doing, and more importantly, you should be looking right now at things like correlation. And the reason I said let's back away from earnings or what, individual stocks right now is because the markets today snapped right back into an incredibly heavy correlated state. What does that effectively mean? Well, when I start talking about correlations, I think one of the best ways to effectively explain that is to look right here. This happens to be the S&P 100. Take a look at its advanced decline line. We're in a correlated state. At that point in time, put away whatever you might think about the markets. You can say, listen, it doesn't matter about Apple or a Google or a Goldman Sachs or a Caterpillar or a Boeing. It just matters that you recognize the S&P futures at this point in time, they are what are driving the bus right now. Sure, the Nasdaq is leading us effectively to the downside, and I'll come to that in just a few moments in terms of some of the different sectors, but individual stocks mean a lot less. Okay, if again, you want to gain a little perspective on the broader market, you got to start looking at things like volatility and, again, specific levels inside of the S&Ps. With that, let's get right into it. Let's look at some of those specifics. First thing I'm going to do is I'm going to cruise over to the chart on the S&Ps. Now, again, I know that very few people that are listening to this may be trading S&P futures. This is not an argument about trading S&P futures or not. As I said, the futures, okay, that's where the hedges are put on. That's where, okay, and effectively what drives order flow. When I say order flow, listen, if a big trade comes into the marketplace, when I see a big trade, there we go. This is all the way down to a 1 day, 1 minute. That's a big trade. You know what that is? Okay, that is basically some 16,000 contracts trading in the S&P futures on a 1 minute basis. Okay, and obviously the futures spike higher, some buy side activity at the exact same time that's going on. If the markets are really heavily correlated, even stuff like Amazon, okay, and Amazon's just having a hideous 4% down day. Okay, if the markets are heavily correlated, don't you think that Amazon is going to feel the brunt of that move? There's the exact same move in Amazon. That's what I'm talking about in terms of understanding, okay, a correlated marketplace. I don't like to make statements without kind of qualifying, kind of quantifying, and that's exactly what I'm referring to, though. But that trade that happened inside of the S&Ps and emerged inside of the S&Ps, and it happened right there at 1339. Okay, that trade was felt no matter what product you might be looking at. Yeah, I pointed out Amazon. I mean, you can even look at something like Caterpillar. Okay, Caterpillar's having just this hideous down day as well, down almost about 4%. There's the exact same minute, down to the exact same second, and the bid higher. So what you have to kind of gather when volatility has kind of fought its way back into the hearts and minds of most traders is what really matters is, again, specific levels. I'm going to start you off, okay, with looking at a 30-day 1 hour. And what a 30-day 1 hour, okay, you've got a couple of lines. I'll come back to those in just a second. Those are what we term gravity points. They're kind of concentric areas of risk. And we expect right now that we should be pinging back and forth between those gravity points. Again, it's all I'm doing is try to elaborate on the fact that we actually came back into some of our gravity points, which is down here at 25.75. We actually checked the box for 26.26. We rallied just literally a point or two shy of 26.82. Now we're right back down into the 26.26 handle. For those of you, if you're not familiar with the gravity points, here they are. Let's open them up in kind of all of their glory. Those are the specific gravity points. These are points that we have been mentioning now, okay, ad nauseum for literally for a year plus of time. I know some of the gravity points we identified right in the middle of this volatility box have been there literally over a year. Right now, what are we sitting on? 26.26. Now, when I say that's kind of a concentric area of risk, it means effectively, okay, we're likely just to close right at that gravity point, trade in and around it throughout the course of the evening, barring any unforeseen kind of circumstances. Now, one of the things you would expect in the days to come, right, and that's why I'm going to whittle back down to a 30-day 1-hour chart. You would expect us to literally be pinging back and forth amongst these gravity points. Why should we anticipate that? Well, for this, I'm going to kind of clean up the chart a little bit here, and I'm going to cruise back over to the spiders. Okay, there was something that we mentioned back in October, November extensively, what we kind of termed the volatility box, right? And as of last week, we actually gained a little footing in there, and we're right back into the volatility box, where effectively we were pinging back and forth between levels. Now, this can really go kind of one of two ways, right? We could just break apart and head right down from here. Obviously, you know, I'm bearish in the marketplace. We could break apart, head right down from here. It's all over but the crying. And how would we know that? What would we be looking for? Well, let me give you some specifics on here. If the marketplace is really going to break apart in the next, day or two, what you would effectively see is coming under 25.75, coming under 25.75 inside of the S&P futures. And that's, again, it's only a stone's throw off. You're like, but that's 50 points. Yeah, well, it's just adding to some of the losses that we effectively took today. But if we're to come off just under 25.75, okay, here's the bottom line with that. Things get absolutely hideous. They get ugly. You're going to feel the fear. All right. And again, 25.75 is literally kind of a make or break point. That was the point in which in December we actually called for a monstrosity of a sell-off. And people, from that point down, we got it. We break under 25.75 again in the very near term. And I'm telling you right now, it's hideous. Okay. What's the probability of the occurrence? I would say the probability of that occurring right here, right now, is relatively low, barring, again, any unforeseen circumstances where, hey, we're always a tweet away from 100, 150 points lower in the S&Ps. But 25.75 is an absolutely key threshold. You should treat it as such. The more likely occurrence in the days to come is that we actually do possibly even come down to 25.75 and ping back and forth off of it into a much more highly volatile state. We may, actually start to form what I would term like kind of a newer volatility box at a slightly lower level, to where we're actually pinging kind of back and forth again, instead of 2,800 down to the neighborhood of about 26. Maybe we form kind of a new volatility box somewhere around 27 and change, all the way down again right to this 25.75 before eventually, and as we do believe, eventually kind of submersing ourselves back into some more serious volatility. So I wanted to give you a couple of different perspectives on that one. And the reason I would sit here in the next few days a little bit on pins and needles, and I'm going to actually show you that next. So that's the gravity points. You've got them listed for you, and feel free to put price, on your charts. Now, with that, the next thing I want to show you has everything to do with the volatility futures. The volatility futures, right? They have actually sat in kind of a poised stance, ready to pounce back on the marketplace. What I'm effectively saying is the volatility futures, they have backed off a lot, right, recently, but they have remained in a state unto which you would believe that the marketplace could be volatile literally at any second. And you're seeing that today. The volatility futures, they flipped back over. Okay, and what I mean by that is look at the 22-day volatility futures versus the 56-day volatility futures versus the 85-day volatility futures. Effectively, what you're seeing once again, short duration volatility is exceeding longer duration volatility. If you wanted to look at that on a chart, I can actually show it in terms of product depth. Okay, this is actually short duration volatility. That means risk right now is greater than it is out in the future, which is typically when you see the volatility futures invert like you're seeing right now, that's duck and cover kind of stuff. And what I was trying to elaborate upon a moment ago was that these volatility futures, even with this monstrosity of a rally going on inside of the S&Ps, all right, look at the rally. I mean, we rallied from 2,300 all the way back to 2,650 and change, and yet the volatility futures have remained in this state where they just flattened out, okay, and very, very abnormal state. They never, kind of regressed back to this is going to be a bullish marketplace. And now, okay, obviously you're seeing possibly why the S&P is only being down about 1.6%. This is not the end of the world. Nevertheless, you got to be feeling the fear a little bit on this, right? So we wanted to mention, again, gravity points, a little bit about the volatility box. You just had a quick glance at the volatility futures. By the way, on top of the volatility futures, okay, I think you also need to pay attention to the VVIX. Oh yeah, that just came back. What the VVIX is saying, okay, all of a sudden nobody's doing nothing. Take your hedges off. The war is over. Everybody get your hedges back on. That's what it's saying. Say all in one lump sum. Get your hedges on, people. Look at the VVIX throughout the course of the day. What the VVIX is, the volatility of the volatility index. Effectively what that means, traders are buying. Again, they are buying, okay, huge numbers of calls inside. There's the closing bell. They are buying huge numbers of calls inside of the VIX itself. Now, the overall volume in the VIX is not by any stretch of the imagination extraordinary. Nevertheless, there's been big movement in terms of volatility itself on the VIX. Again, it's indicative of hedging activity. So the big ticket question that you get in a session like this, and you can see right into this closing bell, we rallied back up. Again, I would anticipate us in the overnight session to kind of, again, head right back down to the happy place of about 26. But more importantly, what can you really expect, in just these next couple of days? Okay, all focus is not so much on earnings. I know that a lot of people, they're going to be scanning for earnings. They're going to be looking for earnings. Here's an earnings scan. What do you got in terms of earnings that's coming up that really kind of lights a fire under the marketplace? I mean, the best thing you really have, this week to me would be none other than something like Intel. I'm not even so inclined to look at IBM. So I would push earnings aside and, make it a sideshow Bob pretty much throughout the remainder of this week, other than maybe Intel, because a lot of chip stocks have had problems. Intel could actually be a big tell. To me, it's still all about the financials. You're like, wait, but financials have passed through earnings. I don't care that they've passed through earnings. They're everything. They're driving a huge amount of the order flow back to the S&Ps. Okay, and the rip-roaring rally here in the financials, it's just shy of the 2650. And I've told you, 2650, that's the line in the sand. We come above 2650. Then, and only then, the entire marketplace starts to feel more bullish. We're still substantially under it. But the bothersome part of today, okay, and I want you to really take a look at this. The S&Ps, right, they're down about 1.3%. The financials, okay, were stronger than the broader marketplace. What does that effectively mean? Well, if the marketplace is going to go into a fit of rage, and again, if volatility is kind of fighting its way back and that marketplace is going to get ugly, it has to be done, not necessarily on the back of some of the technology stocks. It's got to be done on the backs of the financials. And that's really where you want to lay a lot of your focus in the days to come. Now, with those financials, one other aspect, take a look at the bonds. Because if the bonds, if they start to rally, that's it. That's the nail in the coffin. The financials will turn around, sell off. We'll have the S&Ps once again rocking and possibly breaking back below that 2575. A lot to think about inside of today's trading session. Nevertheless, volatility is very much back in play. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.